On June 5th, the VIX jumped to 21.5. That's one of the sharper single day readings we've seen in months. And on the same day, the semiconductor index, the SIX, fell more than 10%. If you looked at your portfolio that morning, you probably felt it. Today, I want to explain exactly what that number means, why it moves the way it does, and what most beginners get completely wrong when they try to trade it. What's up, guys? Coach B here. This is education, not financial advice, and I'll say that again at the end, but let's get into it. So what is the VIX? Here's the plain English version. Every day, the options market is pricing thousands of puts and calls on the S&P 500. Each contract implies how much volatility traders expect over the life of that option. The VIX takes all of those implied volatilities across a specific range of strikes and expirations and condenses them into one single number. That number is the market's best guess at how much the S&P 500 will move annualized over the next 30 days. A VIX of 16, the long run average, basically says the market expects about a 1% daily move, give or take, in a normal environment. A VIX of 21.5 is saying, and things are getting choppier. It's not a crash prediction. It's a temperature reading. Why does it spike when stocks fall? This is the part that trips people up. When the market sells off, investors rush to buy downside protection, puts on the S&P 500. When demand for puts spikes, the implied volatility embedded in those puts gets bid up. And since the VIX is built from those implied vols, the VIX rises. It's a demand signal. More demand for protection equals higher fear gauge. On June 5th, you had a specific catalyst. Broadcom's AI revenue guidance came in around $16 billion. The market was expecting closer to $17.2 billion. That miss spooked the chip sector. The SIX fell 10.3% in a single session. When a major sector gets hit that fast, portfolio managers scramble for hedges. Protection demand surges, and the VIX follows. You also had a May jobs report that same week. Payrolls around 172,000. Unemployment around 4.3%. The data fed into a broader macro unease. None of this by itself would have spiked the VIX. Put it all together, and you got a fear cocktail. Now, here's the single most important thing I want you to walk away with today. You cannot buy the VIX. It is an index. It is a number. You cannot put it in your cart. What you can buy are VIX futures, VIX options, or ETPs, exchange traded products, that are designed to track VIX futures, products like UVXY or VXX. And this is where beginners get absolutely torched. Let me show you why. VIX futures markets are almost always in a condition called Contango. That means the further out futures contracts are priced higher than the near-term ones. To maintain exposure, ETPs like UVXY have to continuously sell the near-month contract and buy the next month out every single month. When you're buying high and selling low every month just to roll your position, you lose money over time even if the VIX stays flat. That's the silent tax. Here's a concrete example. Say you put $1,000 into a VIX ETP in January, expecting volatility to stay elevated. Let's say the VIX stays right around 20 over those 6 months. You might reasonably expect to be roughly flat. Instead, the contango drag bleeds you down to maybe $600 or worse, even with the VIX cooperating. That is the math most people learn the hard way. So what does a reading like 21.5 actually tell you? It tells you the market is on edge. Demand for downside protection is elevated. That's real information. What it does not tell you is which direction the S&P goes next. A spiking VIX has preceded bounces just as often as it has preceded deeper drops. It is a measure of uncertainty, not direction. The most useful thing a high VIX reading tells option sellers, and this is how I'd think about it, is that option premiums are elevated. When the fear gauge is up, implied volatility is high across the board, and that means you can collect more premium than usual selling covered calls or cash secured puts on stocks you're comfortable owning. That's the tactical edge a high VIX can give you if you know how to use it. A VIX back down near 16 is a calmer environment. Tighter premiums, less fear, but also less edge for income strategies. The calibration matters. All right? So let's land this plane. The VIX is not a stock you can trade directly. It's a temperature gauge built from S&P 500 option prices, the market's 30-day fear forecast. When stocks drop fast, demand for protection spikes, implied vols spike, and the VIX follows. What happened June 5th was textbook. Chip guidance miss. Sector sold off hard. Fear spiked to 21.5. If you tried to buy the fear with a VIX ETP without understanding Contango, you learned an expensive lesson. If you understood it, you saw elevated implied volatility as a window to sell premium on stocks you'd want to own anyway. Quick reminder, this is education, not financial advice. I'm not telling you to buy or sell anything. Do your own research. If this one clicked for you, hit that like button and subscribe. It helps more than you'd think. Drop in the comments what market concept you want me to break down next. I read all of them. Good luck in the markets, no matter what stock you're into.